Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We are jumping straight into the deep end today. We're going on a mission to break down two really complex market topics that I think are causing a lot of confusion, especially if you're a newer investor.
For sure. There's a lot of noise out there.
Right. So first, we're going to look at why the latest inflation numbers just feel so unreliable. And then we'll switch gears and explore what low oil prices actually mean for American energy production, specifically when WTI crude dips below that really critical $60 mark.
Yeah, and it's so important to look beyond the surface level on both of those. Recent analysis shows the market's getting whiplash because the headline numbers look simple.
Deceptively simple.
Exactly. When you peel back the layers, the data quality issues, and these bigger structural problems are just making everything more volatile. Our goal here is to help you understand the core mechanics of what's happening.
Because just basing a decision on one number right now.
It's a very risky path.
Okay, so let's unpack this consumer price index, or CPI, dilemma first. Everyone watches it, but it feels like it's giving off faulty signals. I like to think of it as a thermometer for the economy's fever.
That's a great analogy.
But right now, it feels like that thermometer is just broken. It's slow to react, and it's even missing a chunk of data, which makes the reading we're getting pretty unreliable for making any kind of forward-looking decisions.
That analogy holds up perfectly because this distortion is happening in two distinct layers that are basically compounding on top of each other. It creates a very messy picture.
All right, let's start with layer one then, that structural slowness. Why is the CPI basically designed to lag behind reality?
Well, this is the core limitation that institutions like the NBER always point out. The CPI always reflects what's happening slowly because of the sheer weight of slow-moving things inside the calculation. The biggest one is housing, or shelter.
So it has a built-in time lag.
A systemic time lag, exactly. So even if, inflation's cooling off really fast at the grocery store or for used cars, the CPI itself takes months, sometimes over a year, to actually catch up to those real-time changes.
So if we stick with an analogy, if the CPI is this massive ship, housing costs are the rudder, and even if you, the captain, turn the wheel hard because market rents are dropping,
Right.
the inertia of that ship means it takes a really, really long time for its course to actually change. It's a structural problem.
And that's just the background noise.
Yeah.
That structural slowness was then hit with a second layer, which is much more recent and acute, the data gap crisis.
This part is just astonishing to me. We're talking about the ripple effect from the 2025 federal government shutdown. It literally resulted in the Bureau of Labor Statistics, the BLS, just completely missing the October CPI survey data.
That's right. They confirmed it publicly. Survey data was just not collected in October. Collection didn't resume until well into November 14th to be exact, which breaks the whole rhythm.
And that's a big deal.
It's a huge technical factor. You saw sources like Reuters and the Wall Street Journal put out some pretty strong warnings that the recent CPI slowdown might be, quote, technically distorted.
Because they either missed the dates, or when they started again, it was right in the middle of all the holiday sales and discounting.
Exactly. So you combine a structural lag with a totally non-normal data collection, and the report we got on December 18th becomes highly questionable.
So we have a slow thermometer that also missed its last checkup. Okay, let's drill down on shelter. Why is it the biggest villain in all this confusion?
It's simple, really. Shelter is the largest single component in the entire CPI basket. Its influence is just massive. And it's even more powerful in the core CPI calculation. That's the one that strips out food and energy.
So if that one huge piece is misleading, the whole thing is skewed.
The entire core reading gets skewed. And that's the number the Fed uses to gauge where inflation is really heading.
Which is where that lag mechanism really bites. We see private market indicators like, say, Zillow's rent data, showing rents slowing down in real time. But the CPI shelter number always lags. Why can't they just use the Zillow numbers?
It comes down to how leases and contracts work. The NBER points out this lag is caused by the smoothing effect of all the existing leases getting renewed.
Right. Most people don't sign a new lease every single month.
Exactly. You sign for a year, maybe more. So when you have millions of leases expiring and renewing at different times, it takes a long, long time for those new lower market rents to cycle through all the existing contracts and finally show up in the CPI average.
And this brings us to OER owner's equivalent rent. Everyone loves to debate this one. Let's just be really clear. OER is that controversial metric that estimates what an owner would hypothetically pay to rent their own home. It's an estimate.
Right, it's a virtual price, and it gets a lot of criticism. But here's the key thing for investors. Whether it's real or estimated doesn't matter to the market. What matters is that it is a number the Fed and the market actually react to. It directly influences interest rates and asset values because it's part of the Fed's model.
And the November data we got in mid-December showed OER at, 3.4% year over year, and rent was at 3.0%. So they are slowing, but when the data collection itself is broken,
The reliability of that OER number just drops, and that adds even more noise to an already problematic core CPI figure.
which forces us into this dual inflation system, right?
Yeah.
CPI versus PCE.
CPI is the one that triggers that immediate market volatility. It's the headline that hits the screens and causes a knee-jerk reaction. But the Personal Consumption Expenditures Price Index, the PCE, that's the one the Fed actually prefers.
So when CPI reliability is this low, because of the shelter lag and the shutdown data gap, the market gets super sensitive. The question just becomes, which number is the Fed really trusting right now?
And that tension is what causes the whipsaw. When the November CPI headline came in lower than people expected, it immediately fueled all this hope that the Fed could cut rates sooner.
Of course.
But the very same sources warning about the data gap were also cautioning that this technical distortion meant inflation could, rebound sharply in the next report. And that contradiction, a number that looks good but has this known risk, that's what creates massive instability.
So if the headline number is polluted, what is the actionable takeaway here for an investor?
The main insight really is to stop trying to trade that single distorted headline number. You have to focus on the Fed's reaction function.
Meaning, focus on the indicators the Fed will use when they also realize the CPI is flawed.
Precisely.
Okay, so what are those cleaner indicators?
So first, you look at the trend of inflation excluding shelter. If you just take housing out, the rest of it gives a much clearer, more immediate picture. Second, watch the stickiness of service inflation. And third, keep an eye on the pace of cooling in employment and wages. Those three things together give you a much better picture of the Fed's likely path than one flawed CPI report.
So basically, ignore the thermometer reading and instead check the patient's pulse, which is wages, and their breathing rate, the non-shelter prices. If the pulse is slowing and the breathing is stable, the Fed's likely to ease off no matter what that delayed housing data says.
It's a perfect way to put it. When an indicator's reliability drops, the market just becomes overly sensitive to everything, which is why we get those rapid, volatile whipsaw moves. Focusing on the underlying trends helps you filter out the noise.
Okay, speaking of price stability, let's pivot to energy. The oil market is facing its own critical price point, and that's below $60 a barrel. We've seen WTI prices trading in the mid-50s recently, reinforcing this idea of a global supply surplus.
And that $60 level is absolutely the dividing line. When WTI is at or below 60, U.S. shale companies don't necessarily face collapse, but they enter a very specific zone. It's the point where their existing wells stay profitable.
But the growth engine shuts down.
The growth engine shuts down completely. The entire company strategy shifts. It's no longer about growth drilling more, expanding, grabbing market share. The focus becomes purely defense.
And what does defense mean in this context?
Defense means cash preservation above all else. It means managing debt and, really importantly for the market, keeping shareholders happy with payouts and buybacks. They'll work hard to keep current production going, but they slam the brakes on any future expansion.
What's fascinating here is the financial detail that I think most people miss. They confuse the very low cost of just operating an existing well with the much, much higher cost of drilling a new one.
That is the core distinction.
Yeah.
Operating costs are relatively low, keeping the pumps running, paying the staff. Many companies can keep their current wells pumping profitably even at $60. That's the good news.
But the bad news is the all-in break-even cost. That's the real hurdle. It's like you can pay the electric bill for the factory you already have,
Right.
but you absolutely can't afford to build a new factory next door.
That's it exactly. The all-in break-even is a huge number. It includes drilling a new well, capital costs, paying for services, and crucially, building in the expected return you need to justify putting new money in the ground.
Which includes paying out dividends to shareholders.
It absolutely does. And data from the Dallas Fed suggests the average price needed for a new profitable well is somewhere around $65. Some parts of the Permian Basin need even more, like 70.
And we've seen private research that confirms this, right? I think Rystad Energy put the corporate all-in cash flow break-even at about $62.50. So if WTI is below 60, you just can't justify it.
You'd be destroying capital. It forces that shift to the defense strategy. Companies know that trying to grow below $60 is just financial suicide.
And we can see this happening in the field right now. When WTI stays below 60, what are the first two things that get cut?
CapEx, capital expenditure, and the U.S. rig count. The rig count is the industry's activity level. It's basically how many new holes are being drilled.
And that slowdown is already visible. Baker Hughes data showed U.S. oil rig counts falling to their lowest level since 2021. And you hear about stress in big fields like the Permian with companies cutting rigs. I think Surge Energy cut a rig and their CapEx budget.
Yeah, that confirms the whole industry has flipped the switch off of aggressive growth. And, this slowdown actually hits the oil field service companies, the ones doing the drilling and providing the equipment, even harder and faster than the E&P companies themselves.
Why do the service companies feel the pain first?
Well, because the E&P companies can keep operating their existing wells and maintain cash flow, they just stop ordering new work. But for the service sector, if everyone stops ordering new work at the same time, their revenue is immediately cut off.
So their equipment just sits idle?
Sits idle, staff gets laid off. They're the leading indicator for this whole contraction.
So the effect isn't a huge drop in total U.S. oil output because the old wells are still running. It's more of a major slowing of the growth rate.
Substantial slowing, exactly. We've seen analysts like Klappler already revising down their future U.S. supply growth forecasts by, 120,000 to 170,000 barrels per day, all because of weak prices.
Which leads to this really critical insight for global investors. A recent Reuters analysis called WTI below $60, not a sign of collapse, but what was it? A built-in stabilization mechanism for the global oil price.
That's a fascinating way to frame it. And it's true. It's a self-correcting market mechanism. Low prices force U.S. shale to curb its growth, which in turn limits future supply increases. That voluntary slowdown basically sets the stage for a price rebound down the line. It puts a floor under the price.
It also seems to act as a sort of consolidation mechanism. It must really separate the efficient players from the weaker ones.
It does. Investors have to differentiate between the highly efficient large players who can weather the storm and the smaller, high-cost producers. The Dallas Fed data showed the biggest operators might only need $61 to justify new drilling, while smaller ones might need $70. So low prices clean out the weaker players through buyouts or restructuring, while the strongest ones just conserve cash and wait. It's survival of the fittest, dictated by the market.
Exactly. So for an investor, understanding that $60 break-even point is just crucial. It tells you everything about the capital strategy of the entire sector. Below it, you get flat growth. Above it, you get a rapid supply response.
Okay, so let's quickly summarize the two key lessons here.
Sure. First, on inflation, the big lesson is you have to think critically about the data quality right now. Don't blindly trust a single CPI number when it's distorted by both a structural housing lag and a data gap. Focus on the trends the Fed is actually tracking.
Right. And second, on energy, understand that low oil prices trigger a very predictable defense strategy from U.S. shale. That move below $60 slows growth and basically acts as a stabilizing floor for future global prices.
And here's a final provocative thought that kind of ties these two themes together. Because the CPI is so backward-looking due to that shelter lag, the market might actually push the Fed into cutting rates sooner based on weak and, frankly, distorted current data.
But the conflict comes later, right? Months down the road, the structure of the CPI means we could get this phantom pop of high inflation as those old, high-priced leases finally cycle through the index.
Exactly. And that could spike the headline number again well after the Fed has already started cutting.
Which would put them in a really tough communication spot, having to justify their decisions against misleading headlines. That's a fascinating conflict between market expectations and lagged data.
It is a true problem of data versus reality for investors to keep watching.
Indeed. Don't forget to subscribe and hit that like button.